what is materiality? Let's just take that one step back. And what is materiality? Materiality is something is material when it affects the opinion of the user of the financial statement. So I want you all to get into the habit of, when you look at this 1060, the moment you open 1060, the materiality assessment, the moment you hear the word materiality, the moment you see ISA 320, the first word that should come up in your mind is user. That is the only thing that is important as far as materiality is concerned. Who is going to be using these financial statements, and what will affect his opinion of the company? Not his opinion of you or his opinion of the financial statements, his opinion of the company. So if the company, if you say to a user after completing the financial statements, you know what, we found that these financial statements are R2 out in accounts payable. I think most users will be a little bit surprised to hear that it's R2 out, because they know you as an accountant are very thorough and you shouldn't be R2 out. So a lot of you will say, oh my goodness, how did that happen and how are you going to fix it? But I don't think it will change their opinion on the financial statements or their opinion on the company. If they thought it was a good company before, the R2 is not going to make a difference. If they thought that they wanted to buy the company or work for the company or provide a loan to the company or sell to the company, the R2 is not going to make a difference. So the question is simply, what is going to make a difference in the mind of the users? And I actually think if you can understand that, then I don't even need to go any further with this session, because you understand the concept of materiality. In Probe, we take that concept, we call it overall materiality. That's the overall definition, that's the overall benchmark or the threshold that we measure everything against. Right at the end of the audit, we're going to measure everything against overall materiality. So you assess your overall materiality, and you say, okay, I think in this case, let's thumbsuck it. Let's say an amount of R1 million will affect the opinion of the reasonable user in this case. And I'm going to try, this is again technology that I'm struggling with a bit sometimes, so I'm going to try and write on the screen. Please excuse my handwriting here. I'm not quite a Nasbuta when it comes to writing on the screens. So let's say, and I'm just writing it here so that I can remember for my, oh no, it's not working, let me not waste your time. But let's remember overall materiality, maybe write down there next to your screens. Overall materiality, 150 Rand. Sorry, R1 million. R1 million is overall materiality. So that means we have decided now that R1 million will change the opinion of the reasonable user. But now, so what if you find a mistake for 800,000 Rand? Not material. So we'll put it on overs and unders. What if you find a mistake for 700,000, for 600,000? Not material. Well, if I find a mistake for 800,000, I will get a little bit nervous, because materiality is not an exact science. So I will think to myself, what if my R1 million was wrong? What if there was a major mistake in let's say, sales, which I based my materiality on, and for that reason, my materiality is a little bit overstated, and I'm going to miss an error. So what I would do for the design of my financial statement's sake, or for the design of my audit, I'm going to assess something that's a little bit lower than overall materiality, so that I can use that slightly more conservative amount in the performing of my audit work. So overall materiality is still the materiality figure. The figure is still R1 million. But just for the purposes of performing the work, I'm going to assess an amount of slightly less than that, just for performing the work. I use the word performing, so that should indicate to you that materiality figure is going to be called what? Performance materiality. Performance materiality is that amount that we use simply to guide our audit work. It's something a little bit less than materiality, that just is a little bit more conservative than our materiality, so that it gives us that gap for errors, for unadjusted, for uncorrected. That's the problem, most of all, undetected errors. That's what we need a gap for. So that's our performance materiality. Now, the way that the probe methodology works, and please note that you can override all of these. In fact, in hindsight, we actually believe that what we have set here is very conservative. In fact, I think it is probably too conservative. But remember that conservatism, or the level of conservatism, differs between the different firms. I would say that for the average firm, this is too conservative. But what we have said in Probe, the assumption we've made is that if you want to end up with a low audit risk, remember the concept of low, very low, and minimum in previous presentations. Low audit risk is then we're going to take performance materiality as 80% of overall materiality. If you want to end up with very low audit risk, which means you want to make more certain, you're going to look at 60% if you want the minimum audit risk. So you have to be as certain as you can be. Remember, it's not no audit risk, it's minimum audit risk. Then we look at 40%. My experience of firms in practice now that this has been around for a while is that people tend to settle on something between 70 and 80%, I guess. So I would say a figure of 75% would be around about in the ballpark. What determines your audit risk? It's not part of this presentation, but just to refresh your memories again, audit risk is the users, you guessed it, the users of the financial statements will determine that, and also the going concern. So you can actually, if you have your slides printed out or whatever, you can just write down there, or you're making notes, just write down there. The thing that determines your audit risk is users and going concern status of the company. Based on that, you pick a number between 40 and 80%, and I just indicated to you that I think 40% is very conservative. In fact, I think 60% would even be very conservative. Rather pick a number something between 60 and 80%, and as I said, a lot of firms to me seem to settle on 75%. I know some firms actually set it as a norm, just take 75% for everything. Right, so that is your performance materiality. So let's decide, let me just pick a number now. Let's say 600,000. I'm going to take something in the middle of the range on your screen. So we decide now that for this audit that we are doing, overall materiality is R1 million. So R1 million will affect the reasonable user's opinion. But in order to be safe for performance of our audit test, we're going to take that down to 600,000 Rand. We will do our tests, and in the process of doing those tests, we'll use the 600,000 as a norm. When we get to the end, we will go back to our R1 million and consider, is it still reasonable? And we will be back to our R1 million. So R1 million is still the materiality. That didn't change. But for the performance, we're just going to use that 600,000 Rand. Now, I said to you earlier that there are some mistakes that are, so let's say a mistake is, for example, 600,000 Rand. Oh wait, I've just lost my notes on the screen. My slide is going the wrong way around. Okay, so let's say that we have now gone and we found a mistake for 700,000 Rand. What do? Well, now we're going to correct it because it exceeds our performance materiality. What if we find something that exceeds that is 500,000 Rand? Well, now it's less than our performance materiality. What would you do? Put it on overs and unders. 400,000 overs and unders. 300. 200, 100. What if you find a mistake for R2.50 Rand? What are you going to do with that amount? Are you going to also put it on overs and unders? Well, I think you will all agree that that really is not going to go to overs and unders. As far as I'm concerned, that is just absolutely trivial. It is a waste of time. We're not going to put it on overs and unders because even if we find 100 errors like that, even if we find 1,000 errors like that, it is never going to be material. So in the past, we have always had this concept of these amounts are trivial, we're not going to have it. But now the new standards require you to assess right at the beginning of the audit what amounts are you going to consider clearly trivial. And I think you can understand why, because that's something that can be abused if you start getting a little bit airy-fairy about it. So the standard says, set a peg in the ground right at the beginning and say, everything exceeding lower than this amount will be considered clearly trivial. And that is where the next principle comes in the auditing standards, and that is clearly trivial amounts. That's what it's called. Amounts that are clearly trivial. Set, or you decide what are amounts that are clearly trivial. And for probe, what we suggest is that you use 3% of overall materiality. Where does it come from? It comes from research that we've done. It comes from testing, field testing in practice. It comes from talking to a lot of firms. We're looking at the big firms, and we just decided an amount of 3% seems to be appropriate. The regulators seem to be satisfied with 3%. If you look at what people are using out there, you're going to see anything between, I think the lowest I've seen is 0.1%, and I know some firms that use 10%. So if that gives you a range, firms use something between 0.1 and 10%. I feel quite comfortable with the 3% because that means that even if you find 30 errors, it is still not going to exceed overall materiality. And to me, 30 errors make me feel really comfortable. So what it means is that if something is clearly trivial, say it's below the 3%, then we are not even going to record it on overs and unders. In fact, you don't even have to keep track of it. You don't even have to make a note as to why you are not taking it further. Well, obviously, the aspect of qualitative materiality comes into it. If it's fraud or outright theft, then you are going to take it further. But if it's just an error, well, not just an error, if it is an error, then you are not going to even record it on your schedule of unadjusted differences. Right, so let's go back to our example. Overall materiality was R1,000,000. Performance materiality was 600,000 Rand. So what would be clearly trivial amounts? 3% of overall materiality. And 3% of overall is, 3% of a million is 30,000. Is 30,000 Rand. So anything below 30,000 Rand would not even be recorded in this case. And I think some of you might feel uncomfortable about that. Put it in perspective. Think about your clients. Think about something a little bit more realistic. Maybe R1,000,000 for small audits is not so realistic. If materiality was 100,000, then anything below 3,000 Rand would not be recorded. And I must say I feel very comfortable with that, as I said before, because I think even if you find 30 of them, it wouldn't be material. But that's actually quite a stupid argument as well, because you will never find 30 of them. Why I say that is by the time you find the third or the fourth one, you will reconsider your risk assessment. You will see that you've actually made a big mistake in risk assessment because this error has now occurred 3 or 4 times. So I would think that you will never find 30 of them. By the time you get to the third or the fourth one, you will give it back to the client and say there's something big wrong here, let's go and fix it, and hopefully you'll be able to charge extra for that. Okay, so on 1060, which I will show you just now, but I just want to finish the process. On 1060, this is where you're going to, this is the decision process that you're going to go through. Then we go to, well, let's now get started in the audit. We start on the audit and we look at property, plant and equipment, and we say, all right, property, plant and equipment, there's a lot of property, plant and equipment. They've got big plant. 600,000 seems to be a realistic materiality amount for me here. Next item is bank, 600,000. But then I go to the income statement and I see things like directors' remuneration. The directors tend to be a little bit generous in the remuneration they give themselves, and there's a bit of an issue with the Companies Act, Section 45 now, and so on, to make sure that loans, everything is properly disclosed. So maybe for this audit, the 600,000 in directors' remuneration is a little bit high. I feel a little bit uncomfortable with setting 600,000 Rand for directors' remuneration because of these issues that I have already mentioned. So what I'm going to do is, in the old language, we would have said, directors' remuneration, I need to put some qualitative considerations on it. And for directors' remuneration, I actually want to treat everything more than 100,000 Rand as material. I'm being very conservative. I'm going to change my materiality only for that line item and call it 100,000 Rand just for directors' remuneration. Now that aspect of materiality is called specific materiality. So specific materiality is an amount of materiality that you set specifically for a line item. You don't have to do that. You don't have to do it for every line item, but what you do have to do is you have to consider it for every line item. You don't have to do it, you have to consider it for every line item. So you might consider it, I think, for 9 out of 10, no, in fact 99 out of 100 items. You're going to consider it and decide that it's not necessary to do it. We use the 600,000 Rand as materiality as the benchmark, and we leave it at that. So that's your specific materiality. Now, just to complete the circle, you use those specific materiality figures as you go through the audit. We go through the audit. Right at the end of the audit, you go and revisit this whole process before you evaluate misstatements. You go and revisit this process and you consider if my overall materiality is still applicable. Because through the audit, you might now find that, oh, I made a mistake in my sales, and there's actually a huge cut-off error. If I bring that cut-off error into account, then my sales change, therefore my benchmark changes, therefore my overall materiality should have been different. So maybe for that obvious reason I changed materiality. Maybe I made an assessment error in the beginning. I didn't know about a certain user and I find it out throughout the audit. Or maybe I didn't know that something is going to affect the going concern status. I find it out throughout the audit. And then you are supposed to revise your audit, your overall materiality, and as a result, performance materiality, and as a result, clearly trivial and specific materiality, so that the circle goes round and round. But in the end, this is how it works. I think this should give you the big picture. I hope you can all understand it. So just have a moment and just reflect on that screen before I actually take this into practice.